Nothing in this podcast is intended as investment advice, and the people in this podcast may hold positions in the stocks they talk about. Do not buy any investment based solely on the companies we mention. Please do your own research. Hello and welcome to Monday Upbeat Markets with me, Graeme Dickson.
Me, Kevin Hornsby.
Kevin, are you feeling any better?
I'll give you a cough if you want. Cough's not quite as bad, but yeah. Okay. Not feeling great, not feeling bad.
Is this 2 weeks now?
10 days or so, yeah.
Well, get well soon. You would have thought the sun would be good for you out there.
Yeah, I haven't really been outside the house, to be honest with you, so...
No, well, hopefully not too long before you're back to your normal self. So what have you done? Have you done nothing this weekend? Has it been a sit at home and recover?
I actually went to a thing at the church on Saturday. I dragged myself out and went, and it was very good, very useful. But yeah, I was absolutely exhausted. Came back and went to bed. I think about 7 o'clock in the evening. So okay. Just wipes you out when you've got lack of oxygen because your lungs aren't working very well, then it's not good.
No, okay. Well, it's like,
anyway, let's not depress everybody.
No, absolutely not. I mean, at least England had a bit of a clean sweep in sport.
Yeah, I saw that we beat the All Blacks, which was the big deal in rugby. The football. I know we won the games, but I don't even know who we were playing. I think we were playing Albania in the second game.
Yeah. And
what was the score in the end?
I think it was 2-0 to England.
Very good.
And they're playing
very good. Did you watch the boxing?
Do you know what? I would have watched the boxing, but it was a match that didn't appeal to me. I had a feeling it was going to be that result, and from what I hear, it was a bit of a dull fight. And yeah, so I'm kind of pleased I didn't watch it.
Takes us all back nostalgia though, doesn't it?
Yes, it does.
Ben against
they were terrific fights.
They were wars, weren't they? They weren't really fights. They weren't that much to do with boxing either, to be honest. They were wars.
They were. Yeah.
And then the Sons have now lived off the situation, so Conor Ben now can hang his or not hang his head. He can hold his head up high now because he destroyed him, didn't he?
Yeah. Funny enough, there's been a couple of people that are relatively young in that era have passed away. So you've had Mark Kaler, probably don't know that name. Do you know that name, Mark Kaler? He passed away this weekend. He's only like 64. And then you had another chap. There was obviously Ricky Hatton.
Yeah, Ricky Hatton. I think that was suicide, though. No?
I think there's quite a lot of suicides. I think in the industry, unfortunately. I think I don't know if it's mental health or if it's financial, situations. I don't know what happens, but yeah, you often wonder how these people look after their finances once they no longer in the limelight, not earning the sort of massive pay packets. I can assume it's probably like that in most sports, but particularly in the boxing industry.
Yeah, it's a difficult one, isn't it? Both mentally dealing with the limelight and also then the situation with having huge amounts of finances and then probably needing to plan to make sure that lasts you the rest of your life if you don't have other income. So
yeah, it's the lifestyle, isn't it, as well, that goes with it at that time. You're in the limelight. You're the king of spenders as well as the king of earners, and then all of a sudden you have that habit of being the king of spenders, but not having the earnings to back it up. And so it's that huge adjustment from being spend happy to spend thrift.
Yeah, I was watching some sort of documentary about the sheikh though that's come in now from Saudi Arabia. I don't remember his name, to be honest, but he's basically
MBS they call him.
Okay, he's now pretty much controlling a lot of these things because they're talking about.
Sorry, yeah.
Anthony Joshua could fight Jake Paul later on, either early next year or later on this year, which would just be bananas. But I'd like to see it. I'd like to see it, and that's probably why.
Where you have a sort of influencer, a YouTube influencer with limited experience in that field, and then all of a sudden being parachuted to fight some of the best. Maybe they're kind of on the downhill slope. I mean, when he fought Tyson, he wasn't fighting a Tyson, then he went a fraction of himself.
No, you have to wonder what rules Tyson had to box under as well, because there was times that Tyson could have absolutely destroyed him and he didn't. So from what I saw, but there you go. Such is life. So what's been happening in the UK then? Tell me about the politics of the land, because it seems like it's
politics. I mean, we've got so many different things going on. We've got the budget coming up on the 26th of November, and some people are quite nervous about this. I mean, if you read the press every day, it would, you just might want to just go to the nearby ditch and lie down there and wait for your death to come through the oncoming rain. I mean, it's so depressing. The only positive thing is the prospects of a new government in 3 or 4 years' time, and that's what's sort of keeping you holding out there. So that is something that's going on. There's this constant talk of a change of prime minister. Have you any thoughts on that? Have you heard anything about that, Kevin?
Well, he's not making a good fist of it, is he? Nobody really. It seems to be his approval ratings are in the toilet. Literally, nobody likes him. The question you've got to pose is, be careful what you wish for. Is the next lot going to be any better? At the end of the day, it is now. I think the country's now realised we need a radical change. We needed a lot of things to go very, very, very differently. And, this Labour government had the opportunity to do those things, but it's failing miserably. Failing. It's failing pretty much everybody. Even its own voters were, they thought, there was going to be this give the money back to the rich, to the poor from the rich. Well, they're not doing that because there isn't enough money to do it.
Yeah. There's also this sort of, I know you're in Egypt, but you can't help but read it in the online, I'm sure, about the immigration issues that we have in this country, or the illegal immigration issues that we have. And the weekend, there was a lot of fuss about this army base in Crowborough in Kent, not far from Crawley. And I think that there are now this other party, or the Green Party, that are actually very pro refugees, even if they're economic migrants. They're very pro these illegal economic migrants coming into the country, predominantly male, and it is upsetting a lot of people. And I think it's not just upsetting people in the locality; it's upsetting the people throughout the country, because they're seeing this copied throughout the UK. This is not some one-off incident, and they're being put into a military camp. So in some respects, you think, okay, well, at least you're not sort of in a hotel right next to a school. You're fenced off in a military camp away from everything. But there is quite a lot of controversies, particularly the Green Party. There's a lady called Rachel Millward, who is very much welcoming these refugees, which, I guess if you're a genuine refugee, then there's a case for that. But if you're there as an economic refugee, then it's causing a lot of consternation.
I mean, the scenario is that a lot of these people are coming here. Why? They're coming here because the rules and the law is on their side when they get here. We put ourselves in a position where our own laws are making a mockery of what we're trying to do. So I really have we got politicians in the United Kingdom willing to actually step up and make the hard decisions that say these people can't stay? And first of all, we can't let them in the first place. Have we got those politicians? I don't believe we have. So I think it's just going down a very, very dark hole. And we'll look back at these times in history, like the last 10, 15 years, where effectively there's been a huge number of people coming to the United Kingdom who have come to not benefit the United Kingdom at all.
Yeah. Well, I hope that we do have the politicians that are strong enough to stop this this situation getting any worse. And then, well, we'll just have to hope for the best thereafter, and hopefully an improvement on the economic policies, compared to the current government. But in any case, the stock market isn't doing too badly, is it, Kevin? In light of this doom and gloom.
Well, stock market's a forward-looking thing, and especially in the UK, what are our major stocks? Our major stocks are resource-based stocks in a lot of cases. So, should they be doing better? Yes, I think there's no doubt. Whether that be energy, whether it be resources such as gold, silver, copper, all of those different things. Yeah, we should be seeing positives in all of those, because they're going to be things that are required going forward if we move into this AI state.
Well, talking of stocks, we've got a guest who has delivered 250% returns for his funds since the year 2000. His name is Richard Penny from Oberon Investments. So, Richard, my first question to you is: I see that you've got a master's in engineering and economics from Oxford University. How come you're a fund manager and not an engineer, becoming the equivalent of Elon Musk of the UK?
It's the British problem. I mean, the financial market has always been more attractive to people in Britain, but actually it goes back further than that. 40 years ago, before I even went to university, I got involved with privatization issues. And to some extent, that was free money. I used to dig people's gardens, which was hard work. And then these privatization issues came along, and if you had a name, you could apply for them, and they were part-paid shares, and it's almost like free money, as I say. So that got me interested in the stock market. If they'd have gone down, God knows what would have happened. But here we are, sort of. That was 40 years ago, and then in 1992, which is a very long time ago, I went to work up in Scotland as a fund manager up there. So it's always been an interest of mine, and continues to be. Yeah, it was called carpet bagging, I seem to recall. Yeah, well, it was. There were the privatisation issues, and then subsequently you had the building societies as well. You had the Cheltenham Gloucesters and the Halifaxes and the Alliance and Leicesters. So in some ways, sort of the demise of those in 2008, 2009 may have been a huge problem for involvement with the capital markets in the UK, actually. Yes, yeah, true. Kevin, do you recall those days, the carpetbagging days back in the...
I do, and there was quite a few insurance companies involved as well. It wasn't just building societies. I still hold Sun Life of Canada. I think was one of the ones that it did it, and I've still got the shares. I don't know why. I think it was because I lost the certificate. So yeah, I've still got the shares.
Okay. Now, I just want to say, Richard, I had the pleasure of, as an attendee of your conference that you held a week and a half ago at a wonderful Piccadilly. It was really good presentation. So thank you so much for inviting me with you and Simon Like and whatnot. And one of the things that really struck me in that conference was your sort of confidence that for small caps, we are in potentially for a 3 to 4 year bull market. So I wondered if you could expand upon that.
Yeah, so smaller companies have actually outperformed since 1955. It's particularly difficult to believe that at the minute. It's been, in the last 3 or 4 years, one of the most difficult markets, particularly for AIM. And so although small companies outperform in the long term, you just have to remember they're cyclical. So people usually forget at the bottom of cycles. I've been a fund manager for 33 years, and just before the internet boom, there was a big sell-off. That was a good time to buy. 2008, 2009, the downturn then was a good time to buy. And this actually has been a longer downturn. So if we measure from September 2021, which is when interest rates started to go up, to the end of September, the AIM market is down about 40 when the FTSE's up 30. So this is a negative cyclicality of small caps. But usually when you've had such a sell-off, and as I say, this is longer and deeper than it was in the GFC in 2020 and in the internet boom, you get a triple-digit recovery on the AIM. So, to some extent, interest rates have started to go down. That is the classic small cap cycle, is that they're more cyclical. And so actually what we're really saying is when the prices get sold off as they have done, there's lots of opportunities. So that's in general. For a stock picker, there's even better opportunities.
Yeah. Well, that's really interesting. And I think you kind of leading into that sort of assertion that we could be in for 3 to 4 boom years. You did make a remark about a flight of capital away from UK small caps to US large caps or growth companies. I think you remarked in your presentation. Can you expand upon that and why it might be coming back?
Yeah, well, I think obviously everybody's attention has been drawn to the likes of Nvidia and the Mag 7, and that to some extent has been easy money. It's been an easy narrative. And this occurred, from 2021 at the same time as actually there were headwinds with interest rates going up in the UK. So you had negative returns in the UK, really strong performance from the likes of AI. And so initially that was probably the right move to take the money out of the UK, put it there, or even in the UK to put it in cash because you had negative returns. But now, 3.5, 4 years later, some of those negative headwinds have played out a bit in the UK. It's no longer that easy, really, to back the Mag 7. I don't follow them that closely, but they're not cheap. You've had a wonderful earnings progression from the likes of Nvidia, but, are they really overtrading? We don't really know. I mean, I ran an internet fund in 2000, and, there was really compelling momentum in those stocks then, but it didn't end well, as we all know, but you couldn't see it at the time. And so actually really what we're saying is the stock exchange is a discounting mechanism. When everybody loves something as much as they like those Mag 7, then sometimes they get overpriced. When everybody hates, some of these UK microcaps that have been painful, sometimes the price goes down so low that it's almost the equivalent of backing Burnley to beat Man City at 1,000 to 1, really. The narrative is stronger on one rather than the other, but if you take that bet more often than not, it's good. And it's better than that for small cap because at this point in the cycle, absolutely you should have value and momentum.
Yeah. What about this old adage of, when the US sneezes, the UK catches a cold? Do you think there's a detachment in this instance?
The valuation is massively detached. I mean, the UK as a whole is cheaper than the US. It's probably somewhere between 50 and 65% of the valuation of the US. But obviously, if you take the Mag 7 out, that's less pronounced, probably 20-25% undervaluation. But then, of course, you have the AIM and the microcaps have underperformed 70% worse than the FTSE since 2001 out to the end of 24. So the valuation is definitely disconnected. If the US was to sell off, then that could be an issue, but I think it'd be short term and short lived. Ultimately, there is value in the UK, which it's more difficult to say that, and I think people have got an awful lot of their assets in the US one way or another.
Kevin, you got any questions? Sorry.
Yeah. So Richard, you said you started your fund manager in Scotland. Was that in one of the insurance companies?
That wasn't me. That was Scottish Amicable, which subsequently was bought by the Pru. I'd gone to M&G at the time.
Very good. So you were in Scotland for how long before you came back down to London?
It was 4 years, so I was up in Glasgow for 4 years.
Very good. So, how have you seen the market change over that period of time? I mean, even from a cost perspective, the AMCs that used to be charged on the funds as opposed to what it is now, it's a different game, eh?
Yeah, it's different in many ways. I mean, in reality, I think it was an argument, a fine balance between value and growth back sort of 35, 32, 33 years ago. People buy very lowly priced things, or they buy things that grow. It's become much more of a momentum market or a contrarian market now. But momentum's definitely worn out in the last 5 or 10 years. But largely because you've had the passive funds, the index funds coming in. But then ultimately, if some of those very large companies with the momentum keep getting bought, they will be overpriced. And ultimately, as people tell you that the value will out, funds have got bigger. Fund managers have consolidated. If we look at the smaller microcap market, there's probably only 25 or 30 institutions stroke high net worths that could write a check for $250,000 or more if a company needs to raise money. If you go back 30 years ago, that might be 1 or 200. So you would have had all the insurance companies, the Scottish insurance companies. You'd have lots of pension funds that would invest directly. And you would have a lot more sort of savings institutions. You also had, with larger funds, they buy larger companies. So there's less of them buying small companies. And in reality, most institutions will not invest much below £200 million now.
Yeah, so you're a fund manager at Oberon Investments. So how big is your fund, and how many stocks do you hold?
So we run two funds. We run a special sits fund, which is multi-cap. We own some of the Barclays and the Imperial Tobaccos in that, and 40% in small caps. And then we run a pure small cap fund, which is sort of small and micro cap holdings, more on a recovery bias. The first one is 20 million, and the second one is about 10 million. So a very small fund, but the advantage of the small cap fund of 10 million is that we very much have skin in the game. So we're backing high conviction to find stocks that we like, and myself and the management team of the fund own over 10% of it.
Very good. What is your criteria? I mean, how small is micro for you guys?
It's about buying the right things. Sometimes a business at 10 million, if we think it's worth 40 or 50, then we'll back it. If we think it's got enough impetus to rise up the market cap, and for there to be a catalyst to get a revaluation. So yeah, we will go as low as 10 million. And often, at this point in the cycle, what you find is, because of the sell-off we've had on AIM, there's quite a lot of businesses that were trading much higher that are sold down because there's daily redemptions, but there's also fund closures. So people moving UK funds into pan-European funds. You're also seeing the closure of certain UK strategies. And actually, that's an overriding message in many ways, is there's been overselling of many of these small companies in 22 and 23 beyond what the fundamentals would merit. And that's kind of the opportunity which always presents itself at the bottom of a small cap cycle.
So is there a methodology that you follow? I mean, I think most of our listeners will be more interested in the small cap side of things rather than the special sits. Is there a methodology? Is there a certain area that you'd want to invest in? Because for me anyway, I'm looking at the world and saying, boy, we need resources. So we need copper, we need silver, we need gold, we need graphite, we need tungsten, we need all of these different things. And at the same time, we're going to need energy for AI, for data centers, for just general living, and the cost of energy in the UK is horrendous, obviously. So, yeah, well, give us your thoughts on themes.
So we stick to what we know. We know the technology and the healthcare stocks. Reason behind that is they are predisposed to growth, and they have high returns on capital, good gross margins. So we stick to those. Many of those have sold off significantly since September 21. We don't tend to do mining so much. There are people like yourself who would be experts in those, but there's a lot involved with different geographies and different minerals and different engineering processes. So we don't specialize in those so much. But in terms of a process, it's how good is the business? So we've sort of said that there should be medium-term growth, business franchise. So to find good businesses, and then what you pay is incredibly important. I ran an internet fund in 2000. We bought shares when they were very cheap. We made a lot of money, and then we lost quite a lot. So you learn from these things. It's a long time ago. And the take-home message is buy companies that execute in terms of fundamentals and don't pay too much for them. And to that end, when many of the growth companies have sold off in the last 3 or 4 years, and the levels of participation in the smaller market cap is really quite lowly, I would say, at the minute, and that's a pretty strong opportunity.
Yeah, absolutely. Well, give us an idea. What are the top 4 or 5 holdings that you have in the small cap company?
Yeah, so we're looking for the companies that are most sold off are often cyclicals. So big holdings would be on that theme would be ZAR, where we think there's 2 or 3 particularly strong drivers. I made sort of 6 to 8 times my money on that in 2008, 2009. When it went to ceramics. So it had a novel technology for printing tiles, ceramic tiles. We think there's 3 drivers at the minute, being painting cars, electronic vehicle batteries, coating those electronic vehicle batteries, and then color 3D printing. Another business, Mincon, has got it's picks and shovels for mining, hard rock mining. Got a technology called Green Hammer, which looks like it could be disruptive. For that sort of hard rock mining. It already does 120 million of sales, but it feels like that market, the addressable market, is 10 or 15 times as big. Valued pretty much on a recovery basis, so nothing in it for the price. We really like RM, so sometimes you find value in some of the parts where there's 2 or 3 different business units, cash, different types of businesses, and at the core is something really interesting. So RM Group has an assessment business at its center, which is basically marking exam papers, but that's a software business. Historically, it's been a distribution business, so it's valued like a distribution business. Ultimately, we think that will not only see revenue growth in the assessment, but increasing margins and an increasing rating. So that feels like a really good one. Eagle Eye has been a recent addition. They use sort of data sets, artificial intelligence for doing loyalty and personalization of marketing. It's a software business. They've had 2 things this year, one good, one bad. They lost a big customer in America. There was a profit warning and it went down to about twice sales. That's pretty lowly for a software business. It is profitable. But they also signed a sort of framework agreement with a European ERP software company. There aren't too many of those, but I don't think they disclose it. But that potentially could add far more than the loss of the one client. And we think that the revenue base is about 45 million. It could run up to this relationship over a number of years could have almost triple that. And then again, you would have a wonderful scenario where revenues would go up 2 or 3 times, profits probably go up 3 to 5 times, and starting from EV to sales of a couple of times, that could also expand as well. So you could see multiple expansion there. So mostly sort of tech and healthcare, some disruptive technologies, and then some cyclicals. Companies like FDM, would trade, has been a sort of market cap about 10 times as high. It used to be called the Mountfield Group, has been taken private. It's got 40 million of cash. Its profits are down, due to the economic difficulties. But it's well financed. Management is still very engaged, and we think that one will recover.
So what makes you think the small caps are gonna outperform in the next few years?
Yeah, it's just starting from the valuations of what we got. I mean, through most of the cycle, we'll look for companies that can travel over 3 years. There's just far more than that. I mean, we've got 30 companies in the smaller companies fund. there's another 20 or 30 names that we can see out there that have been oversold, and any kind of economic sort of slightly recovery, just a more normal market, even a slightly bad market rather than the very bad one we've had, you would see an improvement in trading, operational gearing, and at some point you will see more interest from other institutions and private individuals. And actually, to that extent, since April, since the sort of Trump tantrum, since April of this year, we have seen good absolute performance in small caps, even AIM, and since June, we've seen an outperformance as well. The little small cap fund we run, we've been going 3 years, but almost to the day. It's really built for a recovery, and we were frankly too early on that because the downturn has been longer. But actually, performance this year has been pretty good, and it's I think it's the best performing UK unit UK small cap unit trust over 1, 2, and 3 years. So sometimes small funds are good, and we are starting to see that recovery.
What's the return that you've had over 1, 2, and 3 years?
So since we launched it, it's up 43%. When we launched it, given it was a downturn, I would have said I would have been disappointed if I hadn't done 100%. But clearly, it's been a very difficult market. We're very pleased to be as good as pretty much the other funds out there. But I would hope that that triple-digit performance is possible. And to put that in context, recall the AIM market has historically done triple-digit recoveries when we've had downturns such as we've seen. We did 173% in 2008, 2009, and I did about 150% coming out of COVID. So those are possibles. That's what's there to beat, and that's what we'll try and do.
How do you smooth out the fluctuations? Do you have a sort of system about when you're selling stock to then harbour some cash and get ready for the next cycle? How do you do it?
So we have a mix of technology and healthcare companies. Healthcare companies tend to be more defensive, if you like. The demand patterns are less cyclical. Notwithstanding artificial intelligence, what you find in a downturn is most technology stocks are cyclical. By definition, technology is new. It's usually a capital investment, and when you hit a downturn, demand is switched off. That's less the case with the likes of the healthcare side. So at the fund level, that's the case. We have on the small cap fund, we have a business called Zagona, which is up to 5 or 6 billion, NCC. So we do have some bigger businesses in there. We tend to run 5 or 6% cash as well.
5 to 6% cash. Very good. Yeah. That Zagona's done extremely well, hasn't it? Can you expand about what do they do?
So Zagona is Vodafone Spain, to simplify it, and a sort of less loved subsidiary of Vodafone PLC in the UK, which was sold into Zagona, which is on the full list actually. It's a bit like those privatization issues I was referring to before. It was sort of very well invested, but sort of slightly institutionally managed. Nobody's really in charge. Nobody really optimizing things. And you had a very aggressive management team from Zagona, who I back then before I was at Legal & General for 15 years, used to own 10% of Zagona. Very capable management team. And their aim was to take, a telecom network and turn the regular billing structure into a kind of infrastructure asset, which of course much more highly valued at sort of almost 3 times the valuation that a telecom would be valued at. So they've gone through that process, merging those network assets with the likes of Orange and Telefonica, and they're partway through that. But because the start point was the downturn of, I think it was the end of 2023, we've sort of seen a recovery, but we've also seen an improvement in the operating metrics of the telecom business, but also progress towards selling these networks to infrastructure funds. And we continue to own it, even though it's gone from £1.50 to £12, because we sold a lot of the shares, but we do still see good upside.
So, Richard, how in a lot of these small caps, especially the micro caps, they're very illiquid. So how do you actually scale out of it? You know, let's say you're up 5 times. How do you scale out of it as a fund?
Well, you sell them on good days when there's people wanting to buy them, when there's good news. You don't wait for a profit warning and try and sell them, because you won't. But what you find is, if you can buy companies at this point in the cycle, I've seen this happen before, and there's enough of a driver, like the likes of Eagle Eye at £100 million, if they really do kick on with this relationship with the ERP provider, you'd see a big expansion in revenues and profits, and it would suddenly go from 100 million below the radar of the institutions to potentially 200-300 million, and it suddenly becomes the most exciting thing on the radar of those kind of guys. So we're buying below where perhaps the main savings groups are happy to continue invested. But if you can get enough impetus, get past the escape velocity back into that, above £200 million, then you find you can actually sell quite easily to those guys.
So how does the market sit in terms of, in the UK market, we've got basically companies that are below 10 million, no funds are touching them basically. Above 10 million to 50 million, there are very few funds that will touch them. Above 50 million plus, there is a few more. Above 250 million, there is a lot more. And then above, let's say, £500 million, then there are multitudes. Is that fair to say? Is that how it would be spread?
Yeah, it is. And actually, 45% of the AIM market, some 500. So the AIM market is about 550 stocks. 45% of the AIM market is under £20 million. There are people that invest there, and it's mostly the VCTs and IHT type funds, mostly tax advantage, and a few high net worths. Interestingly enough, quite a lot of the companies down there are companies that went into the downturn with 2 years cash, but of course it's been 3.5. So many of them are having to raise money, and they're having to raise money at completely the wrong price, which if you're a buyer can be very attractive. So this is I worked on the M&G recovery side when I came down from Scotland, which is very much a contrarian approach. And the reason why that can be interesting is at this point in the cycle, some of the businesses that have made 45 or 50 million pounds maybe break even, and people struggle to process that and value them. But if you can see the assets there, sometimes you'll buy something that will return to 100 to 300 million for sort of 20 or 30 million quid.
Yeah, absolutely. I mean, I can see there's massive opportunity. I mean, we have had a liquidity crisis in the small caps over the last few years. What would you put that down to? I mean, specifically in the UK, we've had a complete liquidity. It's been like a desert.
Well, you're spot on, and it was open-ended funds and the savings market. You did have redemptions there, and if there's 25 investors in small caps and 12 of them have got sales, there's not so many people to buy. There's also been a big problem in the pensions market where, the weighting in UK equities has come down from probably 10 or 15 years ago, 15%. It's down to 4 or 5, depending on which pension structures you're talking about. And I think that would have been 40% if you go back 30 years ago. So all the call for default of pension schemes to have 25% of UK equities is probably would be very sensible. I'm sure nobody's holding their breath for that to happen. But the reality is that the move has probably happened in terms of people going from UK benchmarks where they'd have 15-25% in UK equities to, if they move to a global benchmark, they're probably only going to have 4 or 5%. So the act of going from one to the other has been a big sell-off in UK stocks.
Yeah, do you not see that, or do you not feel, I mean, I certainly do myself, as UK taxpayers, if you are to benefit from the UK tax, then certainly a good proportion of your investments should be revolving around UK companies.
Yeah, well, the Exchequer should demand that. If it's given a tax break, it wants to get a policy benefit, which would be for that to happen. And you don't have to mandate it. You can make sure that default pension schemes put 25% in. That's a better alternative. I mean, I don't particularly like central government forcing people to do things. I don't like them being involved in anything very much, actually, and I think they've proven that recently. But I think you can ask for the default. Most people go for the default on a workplace pension or something like that. If that was to be 25% in the UK, I think most people would go for that, and I think most people expect that it would be. I think they'd be very surprised, for instance, that the MP's pension fund is down at 2% in UK equities. But perhaps I shouldn't really comment on that.
So 2% of the MPs are putting 2% of the superannuation scheme into UK companies. So it's good to see that they're really supporting there should be 100%.
Well, I mean, that's in UK equities, so they may well have more money in other UK assets, but yeah, it's not setting a very good example, is it?
But I mean, Australia does something similar. Obviously, the American market itself attracts its own money, so it attracts it to itself. I think in Japan it's very similar, that you have to have a proportion of your assets invested in your local market, which, I mean, we've basically been given our money away and given tax benefits on it. It's absolutely bizarre.
And the end result, of course, is that for management teams to do well, they're buying back a lot of shares. So they buy back shares rather than invest in the economy. And if people want their kids to go and work and get a job after they've gone to university, of course, there are less of those jobs because they're not investing and growing. So we're not getting the growth because people are buying back shares to make the EPS go up. And that's what UK institutions have demanded under the conditions that prevailed.
Mm. Do you think anybody's brave enough to actually change the rules or not?
I think they are talking about it. I mean, I think there is a recognition that the bigger amount of money is the workplace pensions. The old style defined benefit pensions, they have to de-risk those. That's required. But the workplace pensions, where people go in at with 20 or 30 years left of a working life, absolutely they should be. They have a lot of equities in them, and they should be UK oriented.
And also, I think we should be in a situation where if you're going to get a tax break, such as an ISA or any of these tax breaks, EIS, I think is probably, it has to be UK based, I think, but certainly an ISA. Why should somebody getting those tax breaks invest 100% of their money in the US or around the world? That doesn't make any sense.
I totally agree with you. I mean, in reality, sort of people who are retired and maybe more conservative might not want to put it into the UK AIM market. That's fair enough. Put it into UK, deposit accounts. But why people then get tax breaks to put it in the US, I don't know.
Yeah. Okay, rant over.
Oh, rant. Richard, are you navigating this budget based on all the headlines you're reading, or you just sort of you've already made your move and you'll just see what the end result is and act accordingly? Well,
the majority of our businesses at this stage, I mean, in terms of a small cap portfolio, we're trying to find the valuation anomalies that we think will do well. We actually don't have that many sort of UK domestic house builders or retailers. I mean, they could do well if there's a relief bounce, but some of the names we mentioned are more, although they're based in the UK, they're more global businesses. But similarly oversold.
Yeah. And is your fund open to new investment, or is it closed and people just have to buy your fund in the market?
Yeah. Now, obviously, I'm not allowed to give advice on this, but if somebody were to find £100 down the back of the sofa and thought that it was good for them, it starts from £100 minimum. It's daily traded. It's called the TM Oberon UK Smaller Companies Fund. We have the UK Special Situations Fund, which is a slightly less adventurous version of that. That's TM Oberon UK Special Situations Fund. Available on all the good platforms that people buy things from. Should people think it's appropriate for their risk profiles?
And where's the best place to get information about your funds?
If you go on AJ Bell or Hargreaves Lansdowne, they will have details of it, or indeed our own website. Although we're just going through a refresh, so it might take 2 days, but yeah, it's all on
Which
there.
is what, oberoninvestments.com, is that right?
Yes.
Yeah. Okay. And Richard, what do you do in your spare time when you're not thinking about spreadsheets and stock markets? What do you like doing?
Well, I'm a Leeds United supporter, so I'm obviously not interested in football on that basis. I've got some property in Montenegro, so Montenegro is the value manager's alternative to the Italian lakes, the Bay of Kotor, very beautiful place. I've been involved with that for 20 years.
But Richard, before you go, we have to ask you the 2 questions. First question is, what's your favourite food? And the second question is, what is the best advice anybody's ever given you?
Yeah, I mean, in terms of food, my favourite food would be fish and chips.
Is it mushy peas and lots of salt and vinegar or not?
No, the vinegar is for the devil, and mushy peas. No, you need garden peas, frankly, tomato sauce. But usually cooked in beef dripping. That's the Yorkshire way. And then in terms of advice, it's always you've got to allow a little bit of rational thought kicking. You'll see a great business or a bad business, that initial emotion, you just have to work out how much of the qualitative bit is in the price. So sometimes you find an average business is priced to go bust, and that can be a brilliant investment. And sometimes you see the most brilliant company that's just so highly valued that it's just going to be a poor investment. So you just got to marry the qualitative with the quantitative. The best place to sort of read up on that, if you want to, is Howard Marks, The Most Important Thing.
Very good.
And Howard Marks, of course, is the bond investor, not the Welsh drug dealer.
Yes, I remember. He had a biography, I think, as well.
He did, yeah. But
Yeah. Richard, thank you very much for coming on Monday Upbeat Markets. Thanks a lot.
Thank you very much.
Okay, that was great to get Richard's view. What do you think, Kevin?
Yeah, I thought it was great to see what his thoughts were in terms of the future and what he thinks is going to happen in the small cap market in the UK. So, yeah, let's see how it works in reality. If he's to be believed, and a lot of what he says I believe, then yeah, we're going to have quite a good time over the next period of time. So let's see what happens.
It's 3 or 4 years, I think he was saying, for a bull market. So let's see. Okay, anything catching your eye in terms of performers? Any stocks that have caught your eye in the last week? Anything going forward, Kevin?
I haven't really been watching the market, and that's probably been quite good, a good relief. So the one thing I've been doing is trying to look at what the market's likely to do over the next year or two, in the same way as Richard, and trying to look myself at themes that I think are going to be beneficial in the investing world. And I came up with, it's not rocket science, I came up with resource, and especially focusing on 2 items, which would be copper and gold, whether they be in production or not in production. I think stocks that are going to be involved in that market are going to do very well. The second would be energy, and the third would be anybody who's selling the tools for people to use AI. They're the 3 things, and if there's 1 or 2 that are providing the energy for AI as well, because energy is going to be a huge issue with AI implementation. If we don't have the energy, then we're not going to have the implementation.
I'll just stop you on that point, because there's this talk now of a potential change. We remarked earlier, didn't we, about a change of prime minister. How do you think energy pathways would fare under prime ministers such as Ed Miliband?
Well, there's 2 ways of looking at it, I suppose. Is that he would then be the prime minister and might not be focusing completely on what he is focusing on now, or alternatively, his agenda is going to be pushed even further. I think it's probably going to be a mixture of the 2. But for things like energy pathways, I think quantum energy as well, which was masked, I think also is going to do very well in that situation as well. With the gas peaking stations and the ability to have battery storage in AI centers, AI data centers. We've also got active energy, which is actually in Dubai for the same type of thing. But I think to answer your question, it's going to be a good thing for it. It doesn't really matter now who comes in, because we've built all these wind power stations. We've got to develop the process so we don't pay for them through the nose and not use the energy they produce. So it doesn't matter who comes in. Energy Pathways is one of those stocks that now is going to have to be supported by whatever government comes in. So
plus the gas storage as well, and the fact that they've not invested. The UK government have not invested in the sort of the infrastructure. They've let it sort of die down, and by doing so, it's almost irreversible damage to the oil and gas industry. Which
absolutely.
I
mean, I think there are. I put together a list of about 20 different stocks that I'm interested in, and I'm now narrowing them down in terms of what I think could happen. One stock that had some good news this last week was East Star Resources. Quite a deal that they struck there with one of their majors over the Snowy Mountain gold asset. They're going to spend $20 million on that asset over the next year or two.
That was with Endeavour Mining, wasn't it?
That's right, Endeavour Mining. And I mean, you can't really get much bigger name. And I can't believe that the share price didn't double treble basically on the fact that somebody, it's worth less than £10 million at the minute, and someone's coming in and saying, we're going to spend $20 million on this asset and leave you with 20% free carry. There's no way they're spending $20 million unless they think there's some gold there, and maybe gold copper, if you like, in terms of what it is. So that was one of the ones. I'm still very interested in Canthera. The whole situation there with the makeup or the skincare treatment, I should say, that it's a farm play, but with skincare treatment involved. And I think there's going to be some big deals done on this. It works. My wife's been using it. We got some samples from it. She swears by it. She says it's fantastic. So that just needs some momentum, I think. There was also Ethereum as well. They had a raise that they put through. I think it was £500,000 to get them to the next level so that they can start doing the trading in a greater way in Rwanda. And they've obviously also got the Botswana and the Moroccan assets, as well as the assets in Rwanda. And the assets that Rio have let go in Rwanda, which gives them the opportunity then to use them for a short-term production, even though it won't be necessarily in lithium, but it'll be in other metals that they can then use in terms of their trading. So again, coming back to my view that I really do think there's going to be a difference in terms of how things will perform based on what area of the market that you're going to be in. I think if you're going to be in the market in resources, in energy and in AI, or energy and AI combined, then I think you're on a winner. I don't know how you're not going to be successful. And that's basically what I'm looking at. What have you been looking at, sir?
Well, the one I remarked about last week, WeCap, which has a holding in WeShop. There's lots of weeds in there. It's done quite well. Today it's up 12.2% to 2.75p. And the reason why it's up is because We Shop has at last listed on the Nasdaq Stock Exchange. It was up on Friday. We Shop was up 50%. I think pre-market is up another 50%. So that is something to keep an eye on. At some stage, they will, even though when your company IPOs, it's not necessarily the day when they ring the bell for the actual IPO. So at some stage, they will actually go to the stock exchange, ring the bell. I think it's going to be later this week, and hopefully they'll reveal their plans in greater detail. But it seems to be quite an interesting play. So it's like it's almost like an investment company. The only way, you can now buy shares in We Shop if you want to, but the underlying NAV for WeCap is equivalent to, at that price, is closer to 10p a share, and you can buy it at 2.8p. So why would you buy We Shop if you can buy WeCap at a big discount? But it is listed on Aquis, and Aquis has limited liquidity compared to the Nasdaq, of course. So there's a reason why you would potentially not buy it.
Yeah. What price did you talk about that last week? I forget.
I think it was about 2.4p, so it's not up massively. But
it hasn't moved that much yet.
It hasn't moved that much yet. No, it's not gone up.
But there's potential. I like the idea. I do like the idea. It's one of those opportunities that it's almost like an arbitrage, isn't it?
It's an arbitrage, and I mean, We Shop could become very big, or it may not be, and that's the bit we don't know. But only time will tell there. Another company that sort of caught my eye, a company called Atlantic Lithium, is up 18% today to 9.66p, and there's no RNS on it from what I can see. But there was weekend press apparently in Ghana that they are thinking about abandoning 15% royalties on the mining production there. So I think that might help Atlantic Lithium with their prospects.
Is that AAL, is it?
ALL.
ALL.
Yeah, that's yeah.
Well, what's your thoughts on lithium? I mean, lithium went to the moon a few years ago and then came back down to earth with a rather large bump. And there was obviously a lot of money put into the ground in terms of trying to get lithium out the ground. But do we think we've got the supply of lithium coming now, or do you think?
I think my general opinion is that we're not going to see those major spikes like we saw. I think there's been, like anything, when you have a large, demand increase but a limited supply, then you're going to see new suppliers come to the market, and that's exactly what's happened. We've had, number of new mines coming on stream. I personally think lithium probably has good prospects ahead of it, but I just can't see, especially with new technological changes going on. You could even see a reduction in the size of a battery. You're talking now about these solid state batteries now, which are like a fraction of the original size of battery that will go into a vehicle. So that could, reduce the demand somewhat. Yeah, you've got the supply coming through, but then again, there's going to be a massive expansion in different uses of lithium. You've got now robotics coming through, and that's going to be a massive thing in years to come.
Yeah, battery technology is definitely it's changing, it's advancing, it's doing all sorts of things. I mean, when you see what Musk is trying to do in Tesla, it's did you see there that he's created his own money, effectively his own coin, through and he's going to use or coin stroke card that he's going to be using Visa. Yeah, so all of these technology companies, with the size of them and their ability, can go any which way, I think, in terms of using this technology for many different types of things. What's your view on what happened over the weekend there and before the weekend on Bitcoin and most of the other cryptos that they started
I
to?
kept an eye. I did keep an eye on Bitcoin, and I think going into the weekend it was trading around about $96,000. Then went during the weekend down to $93,000, and then sort of bounced back towards it. And I see Michael Saylor is just unrepentant. He was on Twitter just saying, we're here for the long term. You've had people coming in, like it calls them tourists, coming in, having a go, getting burnt and leaving. And he just does not care. So whether it goes, he's extremely bullish. So is Kathy Wood. I think she came out and she's still saying $1 million is her forecast, I think, by 2030. So I don't know. I mean, they haven't been wrong in the long term. They might get it wrong in the short term, but they haven't been wrong in the long term. And who am I? I'm a nobody compared to them. So I'm a price taker. I will accept as being reasonably accurate.
It's King's new close issue. I've said this about crypto all along. The reality is crypto has no intrinsic value. It has zero intrinsic value. It's basically because there are only 21 million that you're willing to pay for something that there isn't many of. Okay, but that's just the same as if there was only 21 million footballs in the world, you would pay more for a football. As everybody started to collect all the footballs, you'd be willing to pay more for one football. Is it any different? Well, the number of uses and the number of technologies that may get involved with it and are getting involved with it, I think means that it's not as simplistic as what I've just said. I like Tau, which is for the developers. It's like a Bitcoin for the developers. Bitcoin, I think, just has a momentum around it, but quite obviously there must be some big sellers about. Otherwise, how can the price go down the way it has? I mean, it is very, very strictly supply and demand, because ultimately it's on the blockchain. People can even see who's selling, or not who's selling, but what's being sold.
It's the whales. People who bought at, say, I don't know, $100 per Bitcoin, and bought $100,000 worth. I mean, they have, massive wealth, and apparently they've been cashing in. I don't know why. Some of the whales have been cashing in accordingly, but it's been absorbed because you've got the ETF demand, and BlackRocks of this world, and even JP Morgan. I think, are they saying their forecast for next year is $170,000? I think, or I could be wrong.
Yeah. Well, I mean, I think you can make any forecast you want. I've looked at videos where the forecast is zero, so it's like,
yes,
I genuinely doubt it, because there's too much money involved and there's too many people involved. How the rug could be pulled so that it actually becomes worthless, I think is almost, it's not there anymore. I don't think it exists. In the same way as you couldn't say gold is worthless and you couldn't say silver is worthless. The only issue is if there's a technological problem with Bitcoin, as in, people are able to break the codes and effectively go in and steal all the Bitcoins from people, then we've got a big problem. But I don't really see that happening. Though the quantum computing side of things could be very, very interesting. And that's an IPO that's coming to the market in the next week or so. So keep an eye out for that. Oliver did mention it. It's called Delta Gold Technology, DGT. It's on Aquis. I'm not going to say much more about it, but it uses gold in quantum computing. And so have a look at that when it comes out. I'm sure we're going to have some people on and discussing that in the not too distant future.
Yeah. Okay. Well, thank you so much for watching, everybody. And remember, mum's the word.
This podcast was brought to you by Monday Upbeat Markets. If you would like to appear on a future episode of the Mums Podcast, please email mondayupbeatmarkets@gmail.com.